Welcome to Technical Tuesday. This is Fed Razak, Senior Trading Strategist here at CMTrading. And today we're continuing our basics of technical analysis and we're going to break down moving averages. But before we start, make sure to like, subscribe, and share, especially if you find value in this presentation. Okay, so first thing I like to do is give you a definition, what it's used for, and how to apply it. Okay, those are my three goals here today. Now, what is a moving average and how is it applied? So a moving average is really very simple. It's an average of price over time. So you're taking either the closing price of an asset or the average price of an asset on any given day over the past 10 days, let's say, and you're distributing it equally for 10 days, and you're taking the average. So you divide that by 10, and you get an equal distribution for each 10 days, okay, for that simple moving average. Now, why is it used? Well, it's used to give us some confirmation. It's not a leading indicator, but it's rather a lagging indicator, which really means that it gives us a confirmation when a trend is set, okay? And that's really what it's used for mostly. Now, in all fairness, okay, why would I use something that confirms a trend as opposed to something that's going to indicate a trend? So the premise is that trends will continue trending, okay? Now, just because you've gotten into a mid of the trend or the beginning of the trend, you could then still confirm that trend as that trend is continuing in your favor, okay? Now, you don't know when that trend will end, but as long as you're on the right side, okay, and as long as you don't see that the trend is changing, you're on the right side, okay? It might take a break. It might, take a couple of days for it to find itself again and, kind of get back on that trend. But until it's confirming that it's not a trend, that trend is confirmed. So a moving average just gives you that confirmation that something is trending either higher or lower, either in an uptrend or a downtrend. And it's a really useful tool to kind of give you some more conviction so that you could get a little bit more aggressive on the trade, okay? So it's not an indicator, but guess what? It is a confirmer, if that's a real word, for a trend, okay? So it's really very useful when it comes to that, especially here, I said it, in a trending market. Now, we've gone over different type of trending markets, uptrend, downtrend, and range-bound trends, okay? So this is still very useful and no matter what kind of market you're really in. Now, there are different types of moving averages. The first one, if we're just looking at something called a simple moving average, which is an average over price over the equal amount of time, then there are two subsets of moving averages: a longer moving average and a shorter moving average. Now, the basic goal of a moving average is really to give you a curve of the actual market action in real time. So what does that mean? So if you're looking at a Japanese candlestick or you're looking at a bar chart, you don't have that curve to kind of give you an idea of which way we're going, okay? When you're looking at a line chart, then you just have a bunch of lines on your chart. But if you're looking at a Japanese candlestick or a bar chart and you have a moving average, it's kind of like a much more useful tool to interact between the two different types of charting, as we've spoken in last time, okay, between the bar chart or the Japanese chart and the moving average. So it's used within that context very, very well, okay? Especially when you get confirmations of something, either a breakout or something where we're trading either above the moving average or below the moving average. But it's very useful in longer versus short-term trading. Now, in longer time frames, so let's say I'm looking at a 200-day moving average. I'm looking at 200 days, and I'm dividing the price of every single day by 200, and I get that average. Now, if I'm going to be breaking on a daily or on a 4-hour chart, that type of moving average, that's significant, especially if I come close to it in real time. If I come close to breaking a moving average in real time, that becomes huge. It becomes so important. And right now we've done that with gold. Gold has broken its three major moving averages. In fact, it got to a point where it just looked like a flat line between the 30-day, the 200-day, and the 8-day moving average, okay? Now, you could set up your own time frames for moving averages. Okay, you could do a 200-day, a 300-day, a 20-day, but the given is either 8-day, 20-day, or 200-day. Those are the ones that are used. I personally use 8-day, 30-day, and a 200-day moving average. Those are the ones that I go to. Okay, so the longer the time frame and the breaking out or the testing of that longer time frame moving average is that much more important for us as technical traders. Now, a shorter time frame, well, you know, there are usages to that as well, especially if you have crossovers between the 30-day and the 8-day moving average. Let's say that the 8-day crosses over the 30-day moving average, then I say in a much shorter term that my movement in the last, let's say, day or day and a half, whatever short term that I'm looking at, is exceeding my longer term moving average, and I'm getting some sort of change in the market. Either it's getting much stronger or getting much weaker, depending on which way it's crossing over. But one thing is for sure, my current activity is moving higher than my historical average of that particular asset. Now, look at it like this, okay? When you have an average, let's say a monthly average of sales, you have people that will be above average than your average price of sales, and you have people that will be below average. Now, next month, let's say one of the people that were below the moving average is now going to transfer and not just be at the average, but be above the moving average. That's a huge comeback for that particular salesperson. And that's the same thing when it comes to trading, okay? Now, there is, as I mentioned before, two types of moving averages, and we'll delve into that much more next time. But there is something called the simple moving average, okay, which is really that simple, okay? It's the time, okay, so it's 10 days, let's say, and it's the price over that 10-day period. And that's how I get one moving average, okay? That's a simple moving average. There's also something called a weighted moving average, which technical traders like to use much more, and it adds more validity to the current activity in the market. The argument is made that a simple moving average sometimes becomes irrelevant for some of the recent activity. Because if I'm looking at a 200-day moving average, what do I care about what happened 200 days ago? It's not really relevant to the current market activity. But if I'm looking at, let's say, an exponential or a weighted moving average, and I look at it at short term, it's now shifting and it's now actively reacting to the market conditions right now. That becomes a little bit more relevant for my decision right now as to which way I'm going to go in the market. And as an exponential moving average, it's used more as an indicator to give me more of a, not just a confirmation, but give me more of an indication in real time as to what the next steps in the market will be. Thank you for joining us for Technical Tuesdays. We'll see you here next time, and we'll delve further into simple and exponential or weighted moving averages. Thank you, everybody.